Looks like we're live. I'd like to welcome everybody to our almost fall webinar about plan giving. We have our special guest, Neal Myerberg, who is an expert on charitable giving and tax planning. And this should be a very interesting program today, bringing all of you up to date as to what's new with the legacy IRA plans. And so I'm thrilled that you're all here. This webinar will be recorded and will be shared with you. If you have questions in the interim, feel free to put them in the chat and I will bring them to Neal's attention so that he can answer your questions in real time. Of course, for those of you who have participated in these webinars in the past, you know that you can follow up with Neal directly after the session is over to discuss any specific personal questions that you might have in complete confidence. And you can certainly follow up with me as well to ask me any questions that you may have about how to get going on a planned gift that is to benefit Friends of Yad Sarah. In case people leave early or I don't get to speak at the end, I would like just to take this opportunity to wish you all a Shana Tova, a healthy, happy, and productive new year. And without further delay, let me turn the program over to Neal Myerberg. Take it away, Neal.
Let me see if I get my screen. Uh-oh, Rachel, I need help, looks like.
It looks like your screen is being shared. Oh.
Let me try it again. So, share screen. There we are. Okay, everybody okay? Well, thanks for attending, everyone, no matter what part of the country you're in. I hope you're having a really nice day. And I'm going to, I've got a kind of an interesting title with an exclamation point. Whenever there's a title with an exclamation point, you wonder, what's this all about? So it's called It's Working because this is a follow-up to what began in January when the Secure Act 2.0 was passed and enacted for January 1. There was lots of good stuff in there for tax planning and general planning. But what also happened was this 2023 Legacy IRA Act. And the reason why we're talking about it now, even though we may have discussed it back in January, is that most people who take their required minimum distributions from their IRAs do it kind of the second half of the year as they get close to the end of the year. You have to take it in your calendar year for the prior year. And so people sort of don't think about it very much unless they have to have the money earlier for living expenses. So when you get to this point, here it is almost September. September is down the end of this week. We have 3 months going into December to make this decision about the RMD. And be prepared, if you take it out, to pay tax on it as part of your income reported for the year 2023. And it's ordinary income, as you all know. It's part of the government's plan and bargain they had with you that they allowed you to have use pre-tax money to build these IRAs up. They allowed you to have them gain, hopefully, in value, grow in value, realize gains in turnovers without any tax costs. And then they were waiting anxiously to become 70.5 or 72 so they can get the tax. So in essence, this is what this is about. So let's look a little bit at what a charitable gift annuity is, because in essence, this conversation is about getting income for life. And some of you on the call have gift annuities, I believe. And some of you have made inquiries about gift annuities, and you probably know that it's simply a gift of cash or securities to a charity, in this case, Friends of Yad Sarah, in exchange for which you get income for 1 or 2 lives. And it could be people who are related or even unrelated, but they have to be only people named in the agreement. And we know when we create this, based upon the month, what the tax deduction will be. We know what the regular payments will be for life or lives. And we know what portion of those payments will be tax-free. And you do this with a charity in New York, for example, that's authorized by the New York regulators to be able to issue gift annuities. Friends of Yad Sarah is such a charity. Now, there's a second thing to think about. They're called QCDs. You can see it on the screen. It's a code section that created what they call qualified charitable distributions. The purpose of it was to find a way to enable one to take money out of an IRA and not pay tax on it, who otherwise might be making charitable contributions out of checkbook or cash in the bank. So what they're saying is, as of 2015, one could make charitable contributions outright to charity, whether it be for a particular purpose or general support. And if you did it up to $100,000 in a calendar year, that's the maximum you can take to make it tax-free. You could use anything you want coming out of the IRA and pay no tax on it. You could not, under the prior law, up to 2023, use those funds for a donor advised fund or for your own foundation or to get income. So specifically, they could not be used to fund a charitable gift annuity or charitable remainder trust. They could only be used as a tax withdrawal to make a contribution to charities. And there are many of you and many people overall who have done that over the years, simply said, look, I have a regular contribution I make to Yad Sarah, a regular contribution I make to my shul, and I'm going to simply do it by instructing my IRA administrator to send a check in that amount directly to the charity, so I won't pay tax on it. And when I file my tax return for 2023, for example, I'll show that because I did earn X dollars in RMDs, I'll pay tax on less because part of it was being used to make a charitable contribution. So we tried for years, you can see on this screen, to get Congress to allow QCDs to be used for life income plans. Life income plans are charitable gift annuities or charitable remainder trusts. Initially, there was a proposal that said if you're over age 59 and a half, which is the earliest age you can actually take any money out without paying a penalty, why could you not allow people to establish a gift annuity up to $400,000? Because IRS, you get tax money. No, nobody wanted to do that. All payments would have been income. Congress wouldn't even get it out of committee. So this is from 2015, year by year by year. In fact, we tried to get laws to reduce certain amounts. Maybe it wouldn't be $400,000, maybe be $100,000, $50,000. Congress just wouldn't allow it to be used for life income plans because Congress didn't like the idea that you could take IRA money out and pay no tax on it and get income on it until Secure Act 2.0, this particular section, which became law as of January 1, just passed, codifies what is called the Legacy IRA Act and makes certain provisions to enable people to get an annuity from charity in exchange for this withdrawal from an IRA that's tax-free. So the law says if you're at least 70 and a half and you are taking RMDs, for example, you can use up to $50,000 of that in one calendar year, to establish one or more gift annuities or charitable remainder trusts. Now, what does that mean, one calendar year? Well, $150,000 is the max number. One could, for example, if it had 5 charities in mind, give each one $10,000, create a separate gift annuity for each, and have done your $50,000. So the question arises, if I only do $25,000 in 2023, can I take the other $25,000 in 2024? And the answer is no. It's really very specific. It may change as time goes on and the Congress and the IRS start to see revenue loss or revenue gain, but right now, single year. So if one hasn't taken an RMD yet, it's almost September 1, one might say, well, I have to take $50,000 out of my IRA this year, money that I would rather have left in. Money, if I took it out, I was just going to keep it in a money market or maybe buy a treasury or a CD. Why don't I simply use that money to buy gift annuity or gift annuities for myself and my spouse? Other person has to be a spouse for our single or joint lives, and I'll have the money come out of the IRA tax-free. Now, it's an aggregate amount, which simply means if you do 1, 2, or 5 charitable gift annuities, they add up to a total of $50,000. That's your maximum number. Now, if you don't do it in 2023, and if 2024 has an adjustment feature because inflation, and inflation, as you know, is high, but is settling back a bit, then 2024, the amount might be $50,075. But at some point when you do it in that year, whatever year it is, and when you've done it, then at that point you have exhausted it. There is no indication that the Congress and the IRS is going to allow this thing to be a continuing piece of business. But you said that also about QCDs in the beginning, but it became a continuing piece of business, and now it's in law permanently. Will this be a permanent enactment in future law so that you can do X dollars per year of gift annuities tax-free from an IRA? We don't know. We do know what it is now, which is a single use, $50,000 in one calendar year. Now, Adele, I think I saw a question popping up. Did you want to take a look at that and see?
There was a question asked about whether a recording of this webinar will be available to all the participants. And I said, yes, after the webinar is concluded, we will be distributing a link. Not
always-
5 minutes after, but as soon as it's available, we will send it out to everyone.
It's always good to be able to
Feel
answer
free
questions
to-
that way.
Yes, feel free to just pay attention to what Neal has to say and absorb, and you'll be able to go over everything when you receive the material, and can certainly follow up with either one of us with any questions you may have.
Okay. Look at this. These are the rules here. Beneficiary has to be the IRA owner and or the IRA owner's spouse. It has to be an immediate annuity. It can't be deferred. So assuming you're 72, spouse is 72, it starts immediately at the time of contributions. All of the money received in your annuity payments is ordinary income. Why? That's the trade-off for the fact you're paying no tax on the withdrawal from the IRA. Number 3, bullet point 3, no tax deduction. Okay, but that governs any QCD by the same nature. But you wonder, no tax deduction, but I would suggest this to you, and I can't speak for each of you individually, but so many people nowadays don't itemize anymore. The standard deduction's generous enough, and if you don't itemize, having or not having an income tax charitable deduction is irrelevant. So in essence, the relevant part is, I'm getting money out of my IRA tax-free. I'm creating a charitable gift annuity with a fixed rate, which is likely going to be higher than I can get in any other kind of fixed income investment for life or lives. I'll have to pay tax on it when I receive it year by year, but I won't be taxed on the RMD. That's essentially what we're talking about here. And at the end of the term of the gift annuity, which corresponds with the end of the lifetime or lifetimes of the people named, whatever remains, what we call the residuum, goes to the charity that gives you the gift annuity. In this case, if you do it with Friends of Yad Serah, at the end of the gift annuity, whatever remains in it will be used for Yad Serah in Israel. Continuing, if both spouses have IRAs and both are over 70 and a half, they can both use $50,000 from their respective IRAs to create a $100,000 two-life joint and survivor gift annuity. Or, for example, and I've seen this as well, let's suppose the owner of the IRA wants to provide the annuity for the owner's spouse. The owner can take the $50,000 out of the IRA and make the spouse the sole beneficiary of the IRA. And again, I've seen this happen since January. So the funding at $50,000 cannot be added to. Somebody may ask, well, if I use $50,000 for my IRA, can I put $25,000 of other money in it to make a $75,000 gift annuity? And the law specifically says you can't add to it, nor can you have added to it funds that are not QCD withdrawals. It's really interesting how specific the law is. Easy to understand once you see it and hear it, but really micromanaging this process to be certain it's done correctly is what the Secure Act does. Now, if you use that $50,000 in the QCD to buy your gift annuity, and you want to make additional funds available for outright gifts to charity using QCDs, you've used 50,000 of your 100. So it'll eliminate taxes on RMDs. If you use the full 100, 50,000 could be for your gift annuity. The other 50,000 could be for your gifts to charities that don't allow you to have income. And lastly, all this conversation can also apply to any inherited IRAs that you have, that you might have received from another family member that you inherited. They are your IRAs for purposes of taking RMDs and for purposes of creating a legacy IRA gift annuity. So you can see with these rules, they're very specific, and they really talk about what you can do and the limitations of decisions and discretion you have. Who can benefit from it? Certainly non-itemizers who take the standard deduction, because the absence of a charitable deduction is not a factor. Number two, if you don't pay tax on the money coming out of the IRA, the RMD, you in effect are avoiding tax on what would otherwise have been more income. So you might analyze this as saying you've got an above the line deduction. You're reducing your income because the money coming out of your IRA is not going to be taxed. People who want to spread out income tax costs and want lifetime income would likely be happy with this, because why do we create gift annuities? Well, to support our charity at the end of lifetime, but number two, to lock in substantial rates assured for payment by the charity based upon the laws of the regulators, and New York State is the most regulated, and a way to reduce income taxes if you get a charitable deduction. And lastly, I think, and all of us on this call believe this, it's a way to leave a legacy for charity. Yes, you're getting income for life, but at the end, today you've made a statement that at the end of your lifetime, there's going to be something there for the charity or charities you believe in that you love. That's why people give gift annuities. There are a lot of economic benefits, tax benefits, income benefits, but also a philanthropic benefit. So I've kind of done here, given you some sense of what the rules are, but the best way to look at this is look at some illustrations. Let's look at this slide. Here's a spouse, ages 79 and 77, both obviously over the age of RMDs. And one of them or both of them donate a total of $50,000 to get a gift annuity from Friends of Yad Sarah. And based upon the tables of rates that are used and regulators have them filed on behalf of the charities, the 2-life rate for this couple will be 6.6%. They'll be paid every quarter at the end of the quarter. And so they'll get $3,300 a year for life and lives. So it's pretty basic, pretty easy to understand. Payments are made, 6.6% of the full amount, $3,300 a year for life and lives. Now let's look at a single life individual. In this case, somebody who's 72, single life, takes a gift annuity out from an IRA, 1 life gift annuity. Look at the rate. It's almost the same as the rate for the 2 lives, principally because, and this is hard for some of us to really put our heads around, but it essentially means the life expectancy of a 72-year-old individually is not much longer than life expectancy of a 79 and 77 jointly. The presumption is that joint life expectancy is longer than life expectancy of any individual. So in this case, a 72-year-old at 6.7% gets an annuity for life or $3,350. Quarterly at end. Very fundamental. What's your rate? What's your age? What's your amount? How much will you receive? And the $50,000 that you take out of the IRA is not going to be taxed. Now let's assume instead of doing a gift annuity from an IRA withdrawal, for example, you simply take money out of the IRA and you say, well, I'm just going to buy a gift annuity without regard to QCD. I'm going to use my QCD for other purposes. So in this case, we got the same 72-year-old donor whose life expectancy is 14.5 years under actuarial tables that the IRS uses, who says, okay, if I gave $50,000 to the charity, either from my IRA, not a QCD, or from my cash account, my brokerage account, I'll get 6.7%. I'll get $3,350 for life. But since it's not QCD money, I'll get a tax deduction. And my tax deduction, when I did this for an end of August calculation, is over $18,000 as an itemized income tax charitable deduction, exactly $18,397. How you know what a deduction means to you in terms of tax savings is you multiply it by your marginal rate, your federal and state rates added to each other. I've assumed here, for example, that the combined rate of federal and New York is 25%, so therefore the tax deduction will save you nearly $44,600 in taxes, which in effect means you use $50,000 for the annuity, you're saving almost $4,600 in taxes because of the deduction. Your cost is really $45,401, which means if you're getting $3,350 and your net cost is $45,401, your return is really 7.4%. But what line is most relevant for most people is line tax-free portion line, the following line, because it says here when we did this calculation that 65.1% of the $3,350 each year for the first 14.5 years is paid tax-free. At the end of 14.5 years, if either or both of them are alive, it continues to be paid through both lives, but all the income becomes ordinary. At that point, this individual at age 72 will be 76, almost, 86, almost 87. Still gets paid. However, it will be ordinary income then. But this is the comparable. What happens if you don't use QCD money? You simply use money from other sources, including an IRA withdrawal that's not a QCD. Now, 2 lives, same scenario. Donors ages 79 and 77, their life expectancy is 14.2 years. Look how close her life expectancy is, 2 lives, to my 72-year-old whose life expectancy is 14.5 years. It is what it is. So this couple creates a gift annuity for the 2 of them, their lives, with outside money, 6.6%. They get paid $3,300 through both their lives. Here's their tax deduction, close to the other example for a single life. Their tax savings, their net cost, their effective rate, and 67.3% of their payments for both their lives for the 14.2 years is tax-free at 67.3%. After 14.2 years, it becomes taxable income. This is to be compared with the use of a QCD, and let's look at it side by side. Here's our couple. Here's the QCD tax-free withdrawal gift annuity. They're using $50,000. They're getting paid $3,300 a year for their lifetimes. They'll pay tax on it year by year through both their lifetimes. If they use taxable IRA money or cash in general, still get the same payment, $3,300 a year. They'll get a tax deduction. They'll save some taxes. They'll have a tax-free portion of their gift annuity, which they wouldn't have had in this example, but they would have paid income tax on the $50,000. How much would that income tax have been? Maybe 25% of the $50,000. One never knows, depends on the rate. So that's a comparable here. And the same comparison for my single individual. Age 72, $50,000 gift annuity on a QCD withdrawal, tax-free from an IRA. 6.7 is the rate. Payments $3,350 for life. Ordinary income, life expectancy 14.5 years. Payments continue throughout lifetimes. They don't end when we reach life expectancy. Same person says, let me see what the calculation would be if I didn't use the RMD money, if I simply use either other IRA money, or if I use personal money, which most people do, by the way, to get gift annuities. Same amount, same rate, same annual payments, but we have a tax deduction because this is money that is taxable money. So we have a tax deduction, which saves us taxes, reduces our cost, and we get this tax-free portion for the joint life expectancy in this case, and the individual life expectancy in this case of 14.5 years. It's an interesting dynamic to decide upon. Does one use RMD money to avoid paying tax on it and just pay tax on the tax on the gift annuity payments each year? So it's kind of soft because you're not paying any tax on that lump sum withdrawal. Or does one use other money and get a gift annuity to get a tax deduction if you itemize, and get a tax-free portion? It's very difficult to get a fix on this as an absolute. But I'm getting a sense from listening to the commentary of those who have done QCD IRAs, legacy IRAs, that they are more content with having the RMD come out tax-free and deal with the taxes year by year than paying the lump sum tax for 2023. Let me give you all a moment to kind of absorb what we've done and see if you have any questions before I move forward. And by the way, if you don't have any questions, but you do have any questions after this, you can always transmit those questions, and you'll see at the very last screen an email address to send them to. So having said this, let's take a look at this screen, because there are other things you can use for life income planning beside a QCD IRA. One of which would be a charitable deferred gift annuity. Now, you don't have to be 72 or 79 or 77 to do a gift annuity. In fact, you could be much younger and may say in your financial planning, I think I want to find a way to lock in some retirement money that I haven't otherwise done through my pension, my IRA, my 401k, my profit sharing plan. And I also want to support charity. Why don't I make a contribution to Friends of Yad Sarah now? I'm age 60. I'll get a tax deduction now, which I can use because I'm still an earner. I'm still generating income that I can use the deduction to offset. But I'll set the deduction such that I won't receive my first payment till age 70. It's a 10-year deferral. You're making a contribution at age 60, a tax deduction at age 60. You're locking in a rate that will begin at age 70, and that rate will be considerably higher than the rate you would have gotten at 60. And the 10-year deferral period enables the compounding to occur to determine what that rate's going to be. But what's most interesting is the words I'm using here. You can elect a commencement date from a 15-year schedule of payments. For example, if you create a gift annuity and you say, I want my first payment to begin at age 70, we'll give you a schedule, what they call Schedule B, which says, what would your payments be if you did it at 70, 71, 72, 73, up to the age 85? That's 15 years. So when you get close to that 10-year term of your gift annuity, you can advise a charity, either I'm ready to get my payments at 70, or you can say to the charity, well, I'm getting more income than I need right now. I'd rather have a larger amount payable to me at 75 or payable to me at 80. The schedule attached to the agreement at the outset will give you the exact dollar amounts you can expect to receive when you choose the commencement date right before we get to the 10-year period, which was the initial commencement date. These are called flexible deferred gift annuities. Very useful, and I know a number of people who have done these as younger people because they're trying to find particular ways to build assured retirement money at a date in the future. For example, perhaps you're 80-some years old, and perhaps you have a 60-year-old child or two children in their 60s. And you say, well, I would like to create deferred gift annuities for them. It'd be nice if I did it now. I get a deduction now. I don't need the income. This is part of my benefits I'm going to leave for them. And I'll buy them both deferred gift annuities now from Friends of Yad Sarah that will begin paying them at age 70. Or I'll give them the option to choose from the 15-year schedule when they get to be age 70. So there's so much flexibility in gift annuities: single life, 2 lives, current/immediate, deferred with a specific deferral date, deferred with dates that are flexible, that you choose the date in the future. The essence of all this is, it's a way that you're allowed to do this kind of planning because it has an end product for charity. Absent that, you could go to a commercial annuity company. You can do any number of things. You won't get the same flavor of benefits. There'll be some to look for. There'll be some that you could compare side to side with a charitable gift annuity, but they're different. And what makes them principally different is that the end result of that annuity, commercial annuity, is what we call the bottom line of profit for the annuity company. The end result of a charitable gift annuity is charitable good. Money goes to Israel through Yad Sarah, Friends of Yad Sarah, to support an organization that many of you have been supporting and believed in for an absolute long time. Is a charitable gift annuity a better economic choice than a commercial annuity? Perhaps. We can see that. We can see that and compare them side by side. And oftentimes, depending upon age and other factors, a charitable gift annuity produces better economic benefits than a commercial annuity, in addition to giving the money ultimately to charity. And lastly, a complicated concept I'm going to break down for you as simply as I can. A charitable remainder trust is the other way you can fund using a legacy IRA. It's different than a charitable gift annuity because while it sets a rate, the tax payment you make every year from Form K1 you get from the trust doesn't assure you every year of what part would be tax-free and what part would be not, or whether any of it's going to be tax-free, or whether any of it's going to be taxed as capital gain. We don't know that, but year by year. It's not a negative, just something to ponder. Why do people use charitable remainder trust? Essentially because when you have highly appreciated property, stocks, bonds, real estate, works of art, business interests, things that have tremendous amount of capital gain built into them, that if you sold them, the tax cost would be so high that the way many people avoid that initial capital gain is by using them as contributions to a charitable remainder trust. Charitable remainder trust is a tax-exempt trust. The word remainder means whatever is left in the trust at the end of its term goes to the charity or the charities you name in the trust. A rate is fixed, and just like a gift annuity, a rate is fixed based upon life expectancy, not based upon tables of rates, but based upon IRS rules at the moment. That's called an annuity trust. So if you create a charitable remainder trust with $100,000 of appreciated stocks, for example, we look at the tables at that moment, the IRS tables that relate to CRTs. They're not tables, but they're calculation formulas. And we say, what rate could it be? 5, 5.5, 6, 7. We find the rate that corresponds with the rate we could use to make these things exempt from tax. They cannot rate less than 5%. So there's one strategy, which is make it look like a charitable gift annuity. Let's find the rate, multiply by the contribution. If it's securities or real estate, it's capital gain. We won't pay any tax on the gain when contributing make, and we'll pay for life or lives. And by the way, charitable gift annuities, 1 life or 2 lives. Legacy IRA gift annuities, 1 life, 2 lives. Spouses, charitable remainder trust, 1 life, 2 lives, many lives if necessary, not related parties. And they continue to be paid because there's no limit to lives and no limit to how many charities you can leave to, as long as you meet the rules that required the rate to be set so the trust qualifies. Much more complicated, easy to illustrate, just mentioning it to you. The second kind of charitable remainder trust is where people have some market risk tolerance. And this is important for lots of people because somebody will say, well, if I contribute a portfolio of appreciated securities that I don't only pay capital gains tax on to this trust, and the trust sells the securities and pays no tax on the gain, reinvests and pays me 6% each year, then that number is never going to change. That 6% times the, for example, $100,000 that you contribute is $6,000 a year. That never changes. If you choose what is called a uni trust and you fix a rate at 6%, that 6% rate is for the first year's payments. 6% times $100,000 is $6,000. At the end of the calendar year, the trust is revalued by the trustee. And by the way, you can be your own trustee. And when it's revalued, we multiply the revaluation on December 31, if that's the last business day of the year, times the same 6% to determine next year's payments. And if the trust has grown in value from January 1 through December 31, the next year's payments will be higher than they were the prior year. We're trying to build a vehicle here that keeps pace with inflation, but to be very candid, if the trust on December 31, 2024 is lower in value than it was on January 1, 2024, then the payments for 2025 will be lower than they were in 2024. But our belief is with an asset allocation which is reasonable, conservative, but does make market participation, over time it should beat inflation, raise your payments year by year. At the end of the term of the charitable remainder trust, or the end of the term of the charitable remainder uni trust or annuity trust, for example, charities take the remainder. In none of these instances I've told you in this presentation is any of this money includable in your estate for estate tax purposes. It's all exempt because it's completed charitable gifts the moment you have established these. Doing charitable remainder trusts is almost a separate webinar in and of itself. It's complicated. So I'm urging you, if you have any questions about those, about deferred gift annuities, flexible, about charitable gift annuities in general, or about specifically what's working now, the charitable gift annuity using RMD money and paying no tax on it, what we call QCD money, please let us know. We're always glad to help you, and obviously no obligation and only information we're happy to share. Rates, last screen. If you look at this table, rates in multiples of 5 years between each, you can see the rates that Friends of Yad Sarah offers. At age 70, 6.5%, and in the end of August, and will apply also to September, tax-free portion, 63.3%. If you're 75, rate 7.1%, tax-free portion, 68.2%. If you're 80, 8%, tax-free portion, 72.4%. Tax-free portion means how much of the annuity you receive each year will be free of tax. Age 85, 9.5%. Tax-free portion, 76.6%. Pretty substantial. And if you're 90 and over, rate 11.3%. Tax-free portion, 78.1%, which means only 21.9% is taxable. In the month you use cash to establish the gift annuity, these are cash-based calculations. Final calculation is made for that month to determine how much will be tax-free. It's based upon the IRS discount rate for the month. Those of you who've done gift annuities have seen these calculations. You've seen the summary of calculations. You've seen the gift annuity form. Your contract is with Friends of Yad Sarah. Yad Sarah's funds for gift annuities are all invested at PNC Bank, who serves as trustee of not only Yad Sarah's gift annuity program, but many gift annuities programs. It's in a reserve account that New York requires to be segregated from any other obligations of the charity. It has to be sufficient plus a surplus to pay all the annuitants. It's set up in such a way to be almost like an insurance company to assure that people who do this will be paid. One thing you want to be certain of if you do gift annuities is whether the charity you're doing them with is subject to the rules of the most stringent states, New York and California, to assure you that the gift annuity will be paid even if the charity goes out of business. Not likely in this case, even if it does, because there are many states that most of the states in this country are not regulated at all, and you're basing your payments on your trust that the charity will have enough funds to pay you as you go into older age. So our screen to show you how to reach us. You can reach me directly if you wish by email, but when you reach me, I'm speaking to on behalf of Yad Sarah. You can reach Yad Sarah, Shalom at friendsofyadsarah.org, and Adele will be back to you, or Adele and I will be back to you. But in any instance, this is information. This is not a solicitation. Never would intend it to be, but I think those of you who are here are friends of Yad Sarah. And so we're very happy you were here and happy to help you. And Adele, let me turn it to you or to Rachel.
There's a question came up, Neal.
Okay.
A question from a participant to confirm you pay taxes if money goes from an IRA to a gift annuity.
If money goes from an IRA to a gift annuity, you pay no taxes if it's no more than $50,000 in a calendar year. Let me say it again. If you take money out of your IRA to buy a gift annuity this year, any amount of that IRA money up to $50,000, if used for a gift annuity, means you took it out tax-free. You took it out tax-free. That's the essence of this. That money is coming out tax-free. Now, I hope I've answered the question. If I haven't, send a follow-up question to us right now, and I'll pursue it again with you. There's another question.
What about for 2024?
Well, if you don't do it in 2023, you can do it in 2024. But you can only, right now, based upon the existing law, can only do it once in a calendar year and no other time. So either you do it in 2023 or you don't. Now, let me just say what I said earlier. You might think this, well, $50,000, maybe I'll do $25,000 in 2023, and 2024, I'll do the other $25,000. The law says you can't. Law says you have to do it in a single calendar year. And once you've done it in that single calendar year, you can't do it again. Let me just add something to that point. They said when QCDs began in 2015 that it may not exist in 16 or 17 or 18. Finally, they conceded it and said QCDs making outright gifts to charities of money coming out of IRAs tax-free is now permanent. This is not permanent yet, but I can't assure you that if you make a gift in 2023 for your gift annuity using your RMD tax-free, if you'll be able to do it again in 2024, because the law does not yet allow that. Del, do you see anything else?
Any other questions?
Well, let me thank everybody, Adele, and turn it to you for some good remarks about the important work of Yad Sarah.
Hello again, and thank you very much for being with us this afternoon on a very important topic and a very complicated topic, because there's so many new developments that we're pleased to have Neal stay on top of and explain to us and make clear in an easily understandable way. So we hope that this has been useful for you and helpful. And if you'd like any more information about it, or if you'd like to follow up and consider a gift annuity or any of these other life income plans that Neal referenced, we're available to speak with you about it, to answer any questions you may have. And just in conclusion, let me say once again, I want to wish you all a very happy, healthy, and productive new year. And I look forward to being able to welcome more of you into our Legacy Society, Jacob Circle. Thanks again, and all the best.
Bye, everybody.